You went to school for 12 years, maybe 16 if you went to college. You learned algebra, chemistry, history, literature, subjects you've never used once in adult life. But nobody ever taught you the 7 fundamental rules of money that actually determine whether you build wealth or stay broke forever. So here you are making decent money, working hard, doing everything you think you're supposed to do, and somehow you're still living paycheck to paycheck with barely any savings. You think, why didn't anyone teach me how money actually works? Here's what kills me. These 7 rules aren't complicated. They're not advanced finance theory. They're simple principles that separate people who build wealth from people who stay broke their entire lives. And the reason you never learn them isn't an accident. It's because broke people spending money benefits everyone except you. I'm going to break down all 7 rules and show you exactly how to implement them starting today. My name is Max, and I want to help you learn how to make your money work more for you in your life. Today, I'm revealing the 7 money rules that school never taught you. Why knowing these rules is the difference between financial freedom and lifelong financial stress, and the specific actions to apply each rule immediately so you can finally stop feeling broke despite working hard. So, let's get started, and please make sure to hit the subscribe button and give this video a thumbs up if you like it. Okay, let's start with the first rule that nobody teaches you. $1 you save is worth significantly more than $1 you earn. Here's the thing. When you earn $1, you don't actually get $1. You get 70 to 75 cents after taxes, Social Security, Medicare, and state taxes. But when you save $1 by not spending it, you keep the entire dollar. Let me show you the math. You want to buy something that costs $100. To have $100 to spend, you actually need to earn approximately $130 to $140, depending on your tax bracket. That $40 difference is the government's cut that you never see. But here's what most people don't realize. If instead of spending that $100, you invest it at 8% average annual returns, in 30 years, it becomes $1,006. You just turned $100 into $1,000 by choosing not to spend it. Now compare the effort. You have to work multiple hours to earn $130 after tax. To spend $100 on something you'll barely remember in a month. Or you can simply not buy the thing. Invest the $100 and let it become $1,000 over time while you do absolutely nothing. This is where it gets really interesting. According to data from the Bureau of Labor Statistics, the average American household spends approximately $300 to $500 per month on non-essential purchases, stuff they could easily live without. If you redirect just $400 of that monthly waste to investments, it becomes $604,000 over 30 years at 8% returns. You'd have to earn approximately $850,000 pre-tax to have $604,000 after taxes. So by saving $400 per month instead of spending it, you're creating the equivalent of earning an extra $850,000 over your working life. Action step. This week, identify 3 recurring expenses you don't actually need or value. Cancel them. Redirect the money to automatic investment contributions. You just gave yourself a massive raise without working more hours. Rule number 2, never, ever finance something that loses value over time. Look, when you finance a car, you're paying interest on something that's dropping in value every single day. A new car loses approximately 20% of its value the moment you drive it off the lot, and 60% after 5 years according to industry data. Let me show you how destructive this is. You finance a $35,000 car at 6% interest over 6 years. Your payment is $580 per month. After 6 years, you've paid $41,760 total. But the car is now worth maybe $14,000. You paid $41,760 for something worth $14,000. You destroyed $27,760 in wealth. But here's what most people don't realize. If instead of that $580 per month car payment, you drove an $8,000 paid-off car and invested the $580 per month for those same 6 years at 8% returns, you'd have $52,000. You'd still have reliable transportation and $52,000 in investments. Now you might be thinking, but Max, I need a reliable car for work. I'm not saying drive a broken down junker. I'm saying buy a $8,000 to $12,000 reliable used car with cash instead of financing a $35,000 new car. A well-maintained Honda or Toyota with 80,000 miles will run for years and cost a fraction of a new car. The rule, if it goes down in value, pay cash or don't buy it. If you can't pay cash, you can't afford it, and you definitely shouldn't borrow money to buy it. Action step. If you currently have a car payment, calculate exactly how much you're paying over the life of the loan. Then calculate what that monthly payment would become if invested instead. Feel the frustration. Use it as motivation to never finance a depreciating asset again. Rule 3. Your savings rate is exponentially more important than your income level when it comes to building wealth. Here's what most people don't realize. According to research from The Millionaire Next Door, most millionaires in America never had six-figure incomes. They built wealth by living well below their means and investing the difference consistently for decades. Let me show you why this matters more than income. Person A makes $120,000 per year and saves 5%, $6,000 per year. Person B makes $60,000 per year and saves 25%, $15,000 per year. Person B is building wealth 2.5 times faster than person A, despite making half the income. After 30 years at 8% returns, person A has approximately $680,000. Person B has approximately $1,700,000. And person B retires with $1 million more despite earning $1.8 million less over those 30 years. The savings rate dominated the income difference completely. This is where it gets really interesting. Your savings rate also determines how fast you can retire. At a 10% savings rate, you need to work approximately 50 years to retire. At a 25% savings rate, you need about 30 years. At a 50% savings rate, you need about 15 to 17 years. Doubling your income doesn't cut your working years in half. Doubling your savings rate does. Additionally, there's a psychological component. High earners often feel entitled to spend most of their income because they worked hard for it. Meanwhile, moderate earners who prioritize saving build the actual wealth that creates freedom. Action step. Calculate your current savings rate. Amount saved per month divided by gross monthly income times 100. If it's below 15%, you're not building wealth, you're treading water. Commit to increasing it by 5% this year. Rule 4. Debt is a wealth-building tool for rich people and a wealth-destroying trap for poor and middle-class people. Here's the thing. Rich people use debt to buy assets that appreciate or generate income. Rental properties, businesses, investment real estate. The debt is paid by the income the asset generates, and they build wealth through leverage. Poor and middle-class people use debt to buy consumption items that lose value. Cars, furniture, vacations, clothes. They pay the debt from their earned income, which means they're working to pay interest to banks while owning things that are worth less than what they paid. Let me show you the math. Rich person borrows $200,000 at 5% interest to buy a rental property. The rent covers the mortgage payment plus expenses. After 30 years, they own a property worth $400,000 plus paid for by tenants. They use debt to build $400,000 in wealth. Middle-class person borrows $200,000 over their lifetime for cars, credit cards, furniture, and other consumption. They pay it back from their salary plus approximately $80,000 in interest. They use debt to destroy $80,000 in wealth while acquiring things now worth $20,000. Here's what most people don't realize. Interest paid is wealth permanently transferred from you to lenders. Interest earned is wealth permanently transferred from borrowers to you. The rich are on the receiving end. Most people are on the paying end. According to the Federal Reserve, the average American household pays approximately $8,000 to $12,000 per year in interest on mortgages, auto loans, and credit cards. Over a lifetime, that's $300,000 to $450,000 transferred to banks. Action step: list all your debts and the interest you're paying annually. Calculate what that annual interest payment would become if invested instead over the next 20 years. This number should make you angry enough to aggressively eliminate consumer debt forever. Rule 5. The length of time your money is invested matters infinitely more than trying to pick the perfect moment to invest. Look, everyone wants to buy low and sell high. Everyone thinks they can time the market, and everyone who tries this ends up with worse returns than people who just invest consistently, regardless of market conditions. Here's the math that proves it. According to research from JP Morgan Asset Management, if you invested $10,000 in the S&P 500 in 1999 and just left it for 20 years through 2 major crashes, you'd have approximately $43,000. But if you tried to time the market and missed just the 10 best trading days during those 20 years because you were sitting in cash waiting for the right time, you'd have only $20,000. Missing the 20 best days? You'd have $13,000. Nobody can consistently predict which days will be the best days. By trying to time the market, you guarantee you'll miss some of them, which destroys your returns. This is where it gets really interesting. A study by Fidelity found that their best performing investors were people who forgot they had accounts. Dead serious. The people who checked their accounts constantly and tried to time buys and sells underperformed people who literally forgot they were investing. Now you might be thinking, but the market feels scary right now. Shouldn't I wait? No, the market always feels scary. There's always a crisis, always uncertainty, always a reason to wait. If you wait for perfect conditions, you'll wait forever and never build wealth. Action step. Set up automatic monthly investments into a low-cost index fund. Pick a date, say the first of every month, and have a fixed amount transfer and invest automatically. Then stop looking at it daily. Check it quarterly at most. Rule 6. Every dollar of lifestyle inflation you allow costs you exponentially more than $1 in future wealth. Here's what most people don't realize. The natural tendency when you get a raise is to increase your spending to match. You make $60,000, you spend $58,000, you get a raise to $80,000, you spend $78,000. Your savings rate stays constant, which means you build wealth at the same slow pace despite making more money. But here's the rule wealthy people follow. When your income increases, your savings should increase proportionally or more, not your lifestyle. Let me show you the math. You're making $60,000 and saving 10%, $6,000 per year. You get a $20,000 raise to $80,000. 2 scenarios. Scenario 1, lifestyle inflation. You increase lifestyle spending to match. Still saving 10%, now $8,000 per year. You increased savings by $2,000 per year. Scenario 2, capture the raise. You keep lifestyle at $54,000, now saving $26,000 per year from the $80,000 income. You increased savings by $20,000 per year. Over 20 years at 8% returns. Scenario 1, approximately $400,000 accumulated. Scenario 2, approximately $1,200,000 accumulated. Same raise. Same time period. An $800,000 difference based solely on whether you let lifestyle inflation consume the raise or captured it for wealth building. Additionally, there's a psychological trap. Every lifestyle upgrade you make becomes your new baseline expectation. The nicer apartment feels normal after 3 months. The new car feels normal after 6 months. But you're permanently locked into higher expenses for temporary happiness. You are probably wondering, so I should never improve my lifestyle even when I make more money? No. Improve modestly. Take 20 to 30% of raises for lifestyle. Capture 70 to 80% for wealth building. This way, you're still progressing toward freedom while enjoying some benefits of higher income. Action step. Make a commitment right now. The next raise or income increase you get, 75% goes to increasing automated savings/investments. Only 25% can increase lifestyle. This one decision will make you wealthy over time. Rule 7. Building real wealth requires patience measured in decades. And every attempt to shortcut this timeline destroys wealth instead of creating it. Look, this is the rule nobody wants to hear because it's not sexy or exciting. But here's the truth. Consistent, boring investing over 20 to 30 plus years is how virtually all non-inherited wealth is built. According to Fidelity's analysis of their millionaire retirement accounts, the average timeline from starting to save to reaching millionaire status was 25 to 30 years. Not 3 years, not 5 years, decades. But here's what happens. People get impatient. They see someone who supposedly got rich quick with crypto, day trading, options, or some scheme. They abandon the boring, consistent approach to chase the shortcut, and 95% of the time, they lose money. Let me show you the math of patience. $500 per month invested consistently for 35 years at 8% average returns becomes $1,075,000. That's it. That's the formula. It's not complicated, it's not exciting, but it works. The person trying to get rich quick invests erratically, chases trends, loses money on speculative bets, and after 35 years has maybe $150,000 because they kept shooting themselves in the foot trying to find shortcuts. This is where it gets really interesting. The boring approach, index fund investing, consistent contributions, never selling, has a 100% success rate over 30-plus year periods. The exciting approach, stock picking, timing, trading, crypto gambling, has approximately a 5% success rate. You have a choice. 100% chance of building wealth slowly, or 5% chance of building wealth quickly, and 95% chance of staying broke. Seriously, every wealthy person will tell you the same thing. They wish they'd started investing earlier and been more patient. None of them say, I wish I'd tried to time the market more, or I wish I'd chased more get-rich-quick schemes. Action step. Commit to a 30-year minimum investment horizon. Write it down. I will invest consistently for 30 years without trying to time markets or chase shortcuts. This single commitment will make you wealthier than 90% of people. Here's what happens when you follow all 7 rules simultaneously. You save instead of unnecessarily spending, Rule 1. You avoid debt on depreciating assets, Rule 2. You maintain a 20% plus savings rate, Rule 3. You eliminate consumer debt completely, Rule 4. You invest consistently, regardless of market conditions, Rule 5. You capture income increases for savings, not lifestyle, Rule 6. You stay patient for decades, Rule 7. The person following all 7 rules starting at age 25 with a $50,000 income will almost certainly retire a multi-millionaire by age 55 to 60. The person following none of them starting at age 25 with a $50,000 income will likely struggle financially until they die. Same starting point, 7 rules. Completely different life outcomes. And here's the thing that frustrates me. These rules are simple. They're not advanced physics. A 10th grader could understand them, but they're never taught because broke people spending money creates GDP, jobs, and corporate profits. Your financial struggle benefits everyone except you. Look, here's the reality. You weren't taught these 7 money rules in school because the system doesn't benefit from financially educated people who build wealth. The system benefits from people who work for 40 years, spend everything they make, carry debt, and retire barely able to survive on Social Security. But you now know the 7 rules that separate wealthy people from broke people. Saving is worth more than earning. Never finance depreciating assets. Savings rate beats income. Debt builds wealth for the rich, destroys it for everyone else. Time and market beats timing the market. Lifestyle inflation is the silent killer. Wealth takes decades, not days. These aren't secrets. They're not complicated. But knowing them and actually implementing them are 2 completely different things. Your assignment. Pick 3 of these 7 rules that you're currently violating this week, not next month, this week. Take 1 concrete action to start following each of those 3 rules. Cancel the subscription, Rule 1. Calculate your debt payoff timeline, Rule 2. Set up automatic investments, Rule 5. Whatever applies to you, then drop a comment below telling me which 3 rules you're implementing first and what specific action you took. Let's build accountability. Subscribe to this channel because we're going to keep teaching you the money rules that school never did. Hit that thumbs up if this video gave you clarity on why you've been struggling financially. These 7 rules will make you wealthy if you follow them. They'll keep you broke if you ignore them. The knowledge is now yours. The only question is what you'll do with it. Stop waiting for someone to teach you. Stop hoping it'll somehow get easier. Start following the rules that actually work. Your financial future depends on the decision you make right now. Choose wisely.